smarter, more effective way to give to charity? Here to discuss options with me is Nicole Kapoiran-Wyrick from Prosperity Wealth Strategies. Hi, Nicole.
Hi, Hannah. Thank you for meeting with me today. It's great to see you.
You too. So you mentioned alternative ways to donate to charities instead of directly giving cash. Why does sometimes not giving cash make more sense for donors?
That's a great question, Hannah. The benefit of not giving cash can flow through to a donor's tax return in various ways. So that's the reason that this article was prompted. In fact, 3 out of 5 affluent donors give cash to charity via the charity's website. And that got me thinking, we have a lot of planning tools in our tool belt to help clients continue to give in a way that's meaningful to them while also benefiting from a tax perspective.
So you also mentioned, a qualified charity. What makes this a qualified charity?
So a theme that runs through this article is making sure that the gift, the charitable donation, does go to a qualified charity. And all that means is that the charity is a 501c3 organization. And if there's any doubt as to whether the charity you're donating to meets that criteria, any major gift officer at a charity will have that information for you. But in order to take the tax deduction that I note at various points throughout the article, it does have to be a qualified 501c3 organization.
So first you talk about electing standard deductions and itemizing. So I wanted to see if you could explain the difference between those when it comes to charitable contributions.
I'd be happy to, and that's another great question. The Tax Cuts and Jobs Act from several years ago changed the way that most Americans file their tax returns. What that act did is it increased the standard deduction and changed what qualifies as a component of the itemized deductions. So let me back up for a moment. An American taxpayer has an option. They're able to elect the standard deduction or an itemized deduction, and they can elect what gives them the higher deduction. But that Tax Cuts and Jobs Act changed the framework for how those two deductions were calculated. By increasing the standard deduction, most Americans weren't able to meet the threshold in itemizing that exceeded that standard deduction amount. So for 2022, for a couple who's married filing their tax returns jointly, that's almost $26,000. For an individual taxpayer, it's $13,000. In order to itemize, you'd have to have deductions in excess of those figures, depending on your taxpayer status. Now, it's worth noting that charitable deductions are something that are itemized on the Schedule A. However, as I just mentioned, most Americans are no longer itemizing. They're taking the standard deduction. So that's where we have to go back to our planning tool belts and say, what opportunities exist for us to continue to give in a way that feels meaningful while also benefiting from the charitable deduction? And that's part of what this article explores.
So the first method of charitable contributions you mentioned is donating shares. So how can an individual donate shares to charity?
Sure. So one way to give to charity is through donating highly appreciated shares directly to that charity. And here's how it works, Hannah. When an investor donates shares directly to charity, they don't realize the gains in the positions that they're donating to the charity. So let me give you an example. Let's say an investor bought stock for $5,000 10 years ago, and it's worth $10,000 today. So if the donor were to sell those shares, they would have $5,000 of realized capital gains that they would then pay capital gains tax on. If the donor were to give the shares directly to the charity would receive the full $10,000 worth of stock. They would then sell that $10,000 worth of stock, and they wouldn't pay any capital gain tax on the stock because they're a qualified 501c3 organization, which means they're tax exempt. So by the donor giving the shares instead of the cash, in this example, they're actually saving $5,000 worth of capital gains.
That seems like a really smart move.
It is a smart move, Hannah, but here's the challenge. Remember, we just talked about how most taxpayers are not itemizing their deductions. So even though, yes, they're benefiting from not paying the capital gains tax, they might not be able to itemize that $10,000 gift on their tax return. So that's what's prompted evaluating perhaps a smarter way to give. So instead of giving each year to charity, a donor advised fund creates a mechanism where a donor can transfer several years worth of gifts in 1 year into a donor advised fund. And the donor advised fund is sort of like a receptacle where that stock or those shares can stay until they want to recommend a grant to their charity. So how they give the money once it's in the donor advised fund is completely up to them. Again, assuming they're giving to a qualified 501c3 charity. So that's where lumping gifts into multiple years and giving in 1 year can make sense, because then you can exceed the itemization threshold on the Schedule A.
So you also talk about qualified charitable distributions. Could you explain more about that?
Absolutely. So a qualified charitable distribution is a little different than what we've been talking about today. When we're talking about appreciated shares, those shares are held in a taxable account. That's like an individual account, a joint account, a trust account. When we're talking about a QCD, or qualified charitable distribution, that's coming directly from an IRA. So it has a very different tax profile than a taxable account like a trust or an individual account or joint account. So in the case of a QCD, when an American is 72 years old or older, they are required to make a distribution from their IRA account. And because the money that went into the IRA account was tax deferred, so no taxes were paid on the money that went in, when the money comes out, it's taxable at ordinary income tax rates. And once an American reaches that threshold age of 72, they're required to start pulling money out based on their life expectancy. And when they do pull those funds out of the account, it is taxed at ordinary income tax rates. So an alternative would be to give some or all, up to $100,000, of that required minimum distribution directly to the charity. So let's just make an easy example. Let's say a taxpayer has a $100,000 required minimum distribution this year, and they want to give that full $100,000 to charity. So assuming they follow the proper mechanics and the funds go directly to charity, it's important that a taxpayer structure the transfer correctly so as to not incur any unexpected tax liability. The funds would go directly to charity. The taxpayer would satisfy their required minimum distribution, but they wouldn't have to pay any ordinary income tax on the money that came out. So it actually reduces the taxpayer's taxable income by $100,000 in that year. And the exciting thing is that this, while reducing income is exciting enough from a tax planning perspective, it can also have other ancillary benefits on the tax return. So for example, a taxpayer's Medicare premiums are calculated based on 2 years previous adjusted gross income. By giving the money from the IRA directly to charity, the taxpayer is not paying any ordinary income tax on that donation. So it's reducing their taxable income for the year, which then could reduce Medicare premiums. It also could reduce Social Security, the taxation of Social Security, depending on the taxpayer situation. So there can be some ancillary benefits to reducing taxable income that extend to other areas of the tax return, Hannah.
So you kind of have a benefit both, giving to charity, but then also, there's other benefits as well, including you're saying the Medicare premium.
Absolutely, that can certainly be a benefit.
Great. Well, do you have anything else to add about making charitable contributions?
Just that it's so wonderful to see so many taxpayers who want to continue to be generous during such challenging times. And I would encourage all of those taxpayers to pause and to evaluate their mechanism for giving to determine if there's an opportunity to better their financial situation or to be more strategic with their giving. Another option that I just wanted to touch briefly on as it relates to the donor advised fund is that lumping gifts into 1 year allows the possibility to exceed the threshold to itemize your deductions. But this can also be a great income planning tool, because if we're taking all of our deductions and lumping them into one taxable year, we can use this as an opportunity to offset other income. So let's say someone is selling a business or has, for whatever reason, has atypically high income in one year. This is an opportunity to bunch up charitable contributions and have a larger donation in that one year. So it allows for a more strategic way to plan into the future.
Well, great. Well, there you have it. It all seems like pretty great ways to strategize your gift giving. Once again, Nicole Gapoyan-Wyrick from Prosperity Wealth Strategies. Thanks, Nicole.
Thanks, Hannah.